Hi, everybody. It's July 1st. We're starting a new month. Wow, June went super, super fast. We've got a few things going on in the market and some interesting information I read about regarding treasuries and cryptocurrency. First, the main thing off the wire today was the JOLTS report, the job opening and labor turnover survey that showed that there were 7.769 million jobs posted in the month of May. Now that was above expectations of 7.3 million and more than last month's 7.395. These extra job postings are showing us the labor market is still turning, and the demand that the factor of what employers used to have to pay to create demand to come to their company from an existing company for employers is starting to even out. So that wage inflation starting to be evidence, not only within the job market but also within inflation numbers, because it is an important factor within those. So that's the first of the jobs report. We get ADP tomorrow, and then we get the BLS on Thursday. Now, we also had the ISM Manufacturing Index. Now, what this does is it measures the health of manufacturing in the United States. Now, that index rose to 49 last month, and that was above expectations of 48.8, but it's still below that line of 50, and that marks the fourth consecutive month of potential contraction within the manufacturing sector. Now, one thing I was reading today is the relationships of stablecoin to treasuries. Now, with the US continuing to grow and with the big beautiful bill, the BBB, expected to increase the forecasted deficit, more treasuries are going to have to be issued. Now, this would normally be a very bad thing for the bond market, as more supply would need to be absorbed. And there's questions as to the international market with the interest in absorbing more of our treasuries. Now, the source of additional demand, what I talked about, this cryptocurrency, have been on the rise and getting more and more mainstream in the last few years. One of the types of cryptocurrency is called stablecoin. And unlike the very volatile uh, cryptocurrency, this is actually stablecoins actually designed to be stable and pegged to the dollar to make it more suitable to more transactions and more palatable to more investors out in the traditional market. Now, so what backs stablecoin is it's pegged to the dollar, and 80% of that comes from treasuries, typically with shorter term treasuries. Right now, the overall stablecoin market is about $240 billion, which means they've got to keep around $200 billion in treasuries. But with the explosion in this market, the increase is expected to grow to about $2 trillion in the next 3 years. That would mean they would need 1.6 trillion dollars in treasuries. This would be a significant source of demand for the product that we would put out there. And because one of the things is they'd want it to be more liquid, so it'd be on the shorter terms. And if we start terming more of our treasuries to short-term debt, which is what Secretary Bessent really wants, this would absorb a lot of debt and have less 10 and 20-year treasuries out there, which would help the mortgage-backed securities and the mortgage market. So we're going to follow that really closely. Today, I'm looking. Looks like we're up about 4 basis points, 3.5 on the 10-year Treasury, down a little bit on mortgage-backed securities. So we're going to keep a close eye on it. It's a holiday week coming up, a holiday weekend. It's the best time to buy, less competition, gives you more ability to get offers accepted. Give us a call. We're on call from now till all weekend. 616-293-2189. The Market Update Desk with Scott Riley, NMLS 157524. We're your original singular market news source for West Michigan. Take care.